Hi everyone, in this course you are going to learn how to use the engulfing bar pattern as a confirmation signal in combination with supply and demand zones. The engulfing candlestick engulfs or overshadows the candle previous, and the main characteristic of an engulfing candle is the previous candle will fit into the engulfing candle. The size of an engulfing candle is bigger than the candle previous. There are two types of engulfing bars. The bullish engulfing bar, this pattern happens frequently in demand zones and indicate that buyers are more stronger than sellers. The bearish engulfing bar, this pattern occurs frequently in supply zones and indicates that sellers are more stronger than buyers. This candlestick pattern can be used as a confirmation signal when trading supply and demand zones. Look at this example. This is the Euro British Pound 4-hour chart. This is a rally, base, rally demand zone. The basing candle is this doji candlestick. So to draw the zone, you draw the proximal line at the upper shadow and the distant line at the lower shadow to get this demand zone. As you can see, the zone is quick and strong. The candles are big. The previous resistance is broken. This zone is fresh and the risk to reward ratio is good. So when the market retraced back to test this zone, prices formed a nice engulfing bar pattern. The formation of this candlestick pattern indicates that buyers are more stronger than sellers, and they are likely to dominate the next move up. So to enter this trade, it's better to enter at the 50% of the candle's range, because this way you will have a good risk to reward ratio. Whenever you find a big engulfing bar, try to place a limit order at the 50% of the candle's range. Sometimes the market will leave without you, but most of times the market will retrace back to fill out your order and then prices go to the profit target. As you can see in this example, prices retraced back to reach the beginning of this engulfing bar and then the market went up. So if you entered at the 50% of the candle's range, you would join the market in the right time. Your stop loss should be placed below the distant line, and the profit target is this resistance level. This trade provided us with 3-to-1 reward to risk ratio. Look at another example. This is the British Pound GPY 1-hour chart. This is a rally, base, drop supply zone. The basing candle is this failed pin bar. So to draw the zone, you draw the proximal line at the lower shadow and the distant line at the nose. As you can see, the zone is strong, but sellers still find some resistance. As you can see, there is a rejection here, another rejection here, and another one here. So sellers were rejected by buyers, but despite of this rejection, the zone is still strong because the candles are big and strong. The previous support level is broken and the zone is fresh. The risk to reward ratio is good as well. So when the market retraced back to test the zone, we had a nice engulfing bar candlestick pattern. But there is a problem. This candle is big, and if we enter at the close of the engulfing bar and we place our stop loss above the demand zone, we will not have a good risk to reward ratio. So the only way to keep a good risk to reward ratio is to enter at the 50% of the candle's range. If you entered at the 50% of the candle's range, you would join the market because prices retraced back to fill out your order and then it went down. So by adopting the 50% entry method, you will always keep a good risk to reward ratio. As you can see, now the trade offers you at least 2-to-1 reward to risk ratio. Let me show you another example. This is the US dollar Swiss franc daily chart. This is a clear demand zone. As you can see, the move is quick and strong. The candles are big. The previous resistance level is broken. The zone is fresh. And the risk to reward ratio is very attractive. When the market retraced back to test the demand zone, we had a nice engulfing bar as a confirmation signal. But we can't enter at the close of this engulfing bar, because we will not have a good risk to reward ratio. The only way is to place your entry at the 50% of the candle's range. The stop loss should be placed below the distal line, and the profit target is this resistance level. So this is how we can use the engulfing bar candlestick pattern as a price action signal in combination with supply and demand zones. See you in the next lesson.